So, what if the biggest economic crisis of our lifetime? What if it could have been over years sooner? I mean, that's a huge question, right? And it's one that this fascinating paper, A Reconsideration of Money Growth Rules, actually tries to answer. It kind of challenges the entire playbook we use to manage the economy when things go south. So let's dive in.
Okay, I want you to think back to 2008. The whole financial world just felt like it was collapsing, and for so many people, the years that followed were just slow and painful. The big question on everyone's mind, from top economists to regular folks, was super simple. Why? Why couldn't we just get the engine of the economy started again?
Well, a huge part of the answer lies with the main tool that the U.S. Central Bank, the Federal Reserve, uses. And the problem? Well, when they needed that tool the most, its main lever was just completely stuck.
You see, for pretty much as long as most of us can remember, the Fed has acted like a thermostat for the economy. If things get too hot, with inflation, they crank up interest rates to cool things down. And if the economy feels sluggish, they cut rates to heat it back up, trying to get people and businesses borrowing and spending. That was the standard playbook. Simple, right?
And this is exactly where that playbook failed. Just look at what happened in 2008. The Fed absolutely slammed its foot on the accelerator, cutting interest rates again and again and again until bam, they hit the floor. The rate dropped to basically zero, and then it just stayed there for 7 long years.
Now this floor, it actually has a technical name, the zero lower bound. And it's exactly what it sounds like. It's that point where you just can't cut interest rates any further. You've used up all your ammo, but the enemy, in this case a struggling economy, is still standing. And this was the exact trap policymakers found themselves stuck in.
So, with their main tool completely maxed out, what on earth could they do? I mean, what would you do? This exact dilemma sparked this desperate search for other options, which brings us right to the brilliant core idea of the paper we're looking at today.
Now here's the really cool part. The researchers didn't just invent some brand new tool out of thin air. No, instead, they dusted off an old, almost forgotten idea from the economics playbook and gave it a really clever, modern twist.
Here's the core question they asked. What if, instead of targeting the price of money, because that's really what an interest rate is, what if the Fed had targeted the quantity of money? Let's go back to that car analogy. If the interest rate is kind of like the steering wheel, what if they just focused on the gas pedal instead? Directly controlling how much fuel, how much actual money, was being pumped into the economy's engine.
Now, to be super clear, this wasn't about reviving some old-school, rigid idea of constant money growth. A rule that just says increase the money supply by 3% every year, no matter what. No. The paper's idea is way smarter. They came up with a flexible money growth rule, one that intelligently adapts by looking at the real-time health of the economy. It does this by watching something called the output gap. And all that is just the difference between how much the economy could be producing if it was at full strength and how much it actually is producing.
Okay, so you've got this huge what-if question. How in the world do you test it? It's not like you can get a do-over on the 2008 crisis, right? Well, actually, you kinda can. Using a super powerful computer model, the researchers ran what's called a historical simulation. And here's how that works. They basically took a standard model of the US economy, and they fed it all the real-world chaos that actually happened, the housing crash, the panic, all of it. But then, they swapped out one single crucial variable. Instead of using the policy the Fed actually used, they plugged in their new flexible money rule, just to see what would have happened if that had been in charge instead.
I mean, they were essentially rerunning history inside a computer, like in a digital parallel universe, just to see if a different policy could have given us a better outcome. So, what did they find? Was the recovery any faster?
And the results are, honestly, they're stunning. This graph right here says it all. That red dashed line, that's what really happened to the output gap. That's the painful gap between our economy's potential and where it actually was. See how it stayed down there in the red for years and years? Okay, now look at the solid blue line. That's the simulation. Under their rule, the output gap is completely closed by the end of 2009. We're talking about a recovery that happens years faster than what we all actually lived through.
And here's the other bombshell. How did the simulation pull this off? Well, remember how in the real world, interest rates were stuck near zero for 7 years? In this simulated world, rates only had to dip slightly negative for just 2 quarters. 2! And then they went right back to normal. In other words, this policy just completely sidesteps that whole zero lower bound trap.
So let's just recap the incredible findings from this simulation, because it's a lot. You get a much faster economic recovery. That huge output gap closed by 2009.
You avoid that 7-year nightmare of being stuck at near zero interest rates. And you keep inflation positive, which means you avoid the dreaded risk of deflation. I mean, it really sounds like a win-win-win.
So look, these results are more than just some cool academic what-if. They force us to ask some really tough, really important questions about the future of economic policy. It makes you wonder, is it time to completely rethink the standard playbook?
And the authors themselves, they don't pull any punches on this. They conclude, and I'm quoting them directly here, that a rule targeting the money growth rate, quote, should be added to the list of possibilities considered. I mean, that's a direct challenge to the way things have been done for decades.
And this is a conversation we need to be having now more than ever. The world has changed. Interest rates all over the globe are just way lower than they used to be, which means the risk of hitting that zero lower bound trap in the next crisis is dangerously high. Central banks know they need new tools in their toolbox. And what this paper suggests is they might have a surprisingly powerful one just sitting there, waiting to be used.
So it really leaves all of us with a critical question for the future. As we try to navigate this new economic world where the old tools just aren't working like they used to, what new strategies are we going to need when the next storm inevitably hits? Now, this research doesn't claim to have all the answers, but it sure does give us one compelling and maybe even vital new place to start looking.